Imagine a financial system with no borders, no closing bell, and no pause button, where money never sleeps and trust exists only in lines of code. This is a digital frontier, the world of cryptocurrency, a realm of breathtaking risk and staggering reward, a place where fortunes are made and lost in the blink of an eye. For years, the central challenge of this war was finding the moments of calm in the middle of the storm, a safe harbor, a digital bedrock. Then came the stablecoins, the digital tokens designed to do one thing perfectly. It is to maintain their value. And among them, one rose to prominence as a standard bearer of trust, transparency, and stability. It was built by a US-based company, regularly audited and fully backed by real-world dollars. It was called USDC. It was a safe one, the digital dollar, the very foundation upon which the new world of decentralized finance was being built. This is the story of how the most trusted dollar in crypto nearly collapsed overnight, a digital bank run that exposed just how fragile stability can be. Because in this new financial frontier, even the safest asset can spark a crisis. It is a reminder of how fragile trust really is. And the real story? It is what came after, the fight to rebuild that trust. To understand how it all unraveled, we first need to understand why USDC became the cornerstone of the digital economy in the first place. Created in 2018 by a consortium co-founded by Circle and Coinbase, USDC's entire strategy was built on one word: trust. Their first key decision was to position themselves as the anti-Tether. Tether, the original stablecoin, was notorious for its opaque accounting and questions about whether its reserves were truly backed one for one. In contrast, Circle committed to holding one real liquid US dollar for every digital USDC token issued. They hired top accounting firms to publish monthly public attestation of these reserves. It is a masterstroke of transparency in a world desperate for it. Their second innovation was embracing regulation. While other crypto projects clashed with governments, Circle actively collaborated with US regulators. That made USDC the preferred stablecoin for mainstream institutions and cautious investors. Soon, it became the primary unit of account in the world of decentralized finance. It was just like a poker chips of crypto, used for lending, borrowing, and trading billions of dollars every day. By 2022, USDC had over $50 billion in circulation, rivaling Tether for dominance. It was integrated across more than a dozen blockchains, from Ethereum to Solana to Polygon, enabling seamless movement of digital dollars across crypto universe. And this success introduced a classic strategic problem that every innovator eventually faces. Where are the hidden risks in your system? The turning point wasn't a hack or crypto scandal. It came from the most traditional, boring corner of finance imaginable, a regional bank in California. On Friday, March 10, 2023, Silicon Valley Bank, a cornerstone of the tech industry, catastrophically collapsed, sending a shockwave through global finance. For Circle, the external factor was simple, a classic bank run, but the internal factor was devastating. It is risk concentration. Late that Friday night, Circle made a stunning disclosure. $3.3 billion of cash reserves back in USDC were held at the now-defunct Silicon Valley Bank. That money was suddenly, terrifyingly inaccessible. This was a perfect, brutal illustration of an engineering concept known as single point of failure, or SPOF. SPOF is any part of a system. If it fails, stops the entire system from functioning. While Circle reserves were spread across several banks, their exposure to Silicon Valley banks was large enough to create a critical fault line in their chain of trust. Now let's trace the causal link from that single failure to the near collapse of the stablecoin. Silicon Valley Bank fails, trapping $3.3 billion of USDC's collateral. Markets realize USDC is not 100% liquid and redeemable as promised. that ironclad trust, their entire brand identity evaporates in an instant. Billions of dollars of USDC are dumped in minutes. Unlike a traditional bank run that unfolds over days, this one happens at the speed of code. The immense selling pressure overwhelms buyers. USDC price snapped from $1 to 87 cents. The stablecoin becomes violently unstable. Liquidity dries up across DeFi. Protocols freeze. Fear spreads faster than any contagion before. And then, silence. Over that frantic weekend, salvation came from outside of blockchain. The US government stepped in, granting all deposits at Silicon Valley Bank. Circle's funds were safe. By Monday morning, the pack was restored. But surviving a crisis is one thing, preventing the next one is a different challenge entirely. Circle's leadership understood that regaining confidence required more than relief from Washington. It demanded a complete re-architecture of their system. They took two decisive steps. Step 1 was diversification. They radically diversified banking partners, moving reserves to large global institutions like BNY Mellon and away from regional banks. No more single points of failure. The Treasury pivoted as a step 2. They shifted the majority of reserve into short-term US Treasuries, instruments backed by the full faith and credit of US government. In essence, Circle made the strategic decision to trust sovereign, not just private bank. It was a subtle but profound evolution from bank-dependent trust to state-anchored resilience. By 2024, this structure made USDC one of the most conservative digital assets on earth. The irony? It took a crypto crisis to make a stablecoin more conservative than most banks. But this story isn't over. Circle's next chapter may determine the future architecture of digital money itself. In 2025, Circle went public, raising over $1 billion in its IPO and reaching a valuation near $8 billion. It was a bold signal. Circle is not just a crypto startup anymore, it is a financial infrastructure company, and its mission is expanding. Regulation as a competitive edge. While rivals fight compliance, Circle is doubling down. It supports the proposed Genius Act in the US, which would bring federal oversight to stablecoins and grant licenses to trusted issuers. If passed, it could make USDC one of the first federally regulated digital dollars in history. In Europe, USDC has already become one of the first stablecoins to comply with MiCA, the EU's sweeping crypto regulation, letting it function legally across all member states. Within the Circle Payment Network (CPN), Circle is rolling out a global payment network, enabling banks, fintechs, and enterprises to use USDC for cross-border settlement, payroll, and commerce without ever touching a crypto exchanges. It is programmable money for institutions. The hybrid monetary system. The future of money may not be a battle between governments and crypto, but a partnership. Central banks will provide the trust and legal backing, while stablecoins like USDC deliver speed and innovation. Circle calls it the Internet of Value, a world where digital dollars move as easily as sending an email. In the future, USDC could become the financial engine that powers the internet economy. The near failure of USDC was more than a crypto event. It was a live stress test of our financial future, revealing 5 profound lessons for every innovator, investor, or builder operating at the edge of trust. Lesson 1. Trust is your most valuable collateral. Even with one-to-one reserves, trust can evaporate faster than liquidity. In finance, perception is solvency. If your customers believe your reserves are inaccessible, the numbers don't matter. Belief collapses fast. Lesson 2. Eliminate single points of failure. Circle's exposure to Silicon Valley Bank was a textbook as POF. Their pivot to US Treasuries showed the corrective playbook. It is a reminder for all of us to always ask hard questions. What is the one single point of failure that could bring down everything I have built? Lesson 3. Manage the information cascade. The digital bank run exposed the psychological law of modern markets, the information cascade. Once a few large holders sold, others follows blindly. In today's hyper-transparent, real-time world, controlling the narrative is as vital as controlling your balance sheet. Lesson 4. Architecture beats popularity. In a network economy, success isn't about being the most used, it is about being the most resilient. Circle survived because its architecture evolved faster than its computation spanning. Lesson 5. The future of money is narrative. Every dollar, physical or digital, is a story we collectively agree to believe. And whoever writes the story controls the flow of trust. USDC challenge is to ensure its next chapter is the one the world continues to believe in. The crisis of 2023 was a warning shot, a reminder in the age of programmable money, stability is not a feature, it is a constant fight. Because whether money lives in banks or in code, one truth remains. The most valuable currency on earth isn't gold or crypto or even dollars, it is trust.